Welcome to Taking Stock for the week ending 6th of June 2025, where once again, myself, Tim Lincoln, and our Head of Stock Doctor Research, Kien Trinh, streamed you all things share market. How are you, Kien?
Yeah, not too bad, Tim. I can't believe time has gone so quick. It's close to the financial year approaching now.
Yeah, and the financial year's upon us. Yeah, time flies, doesn't it? But always plenty to keep us busy, isn't there? But great to be with you, Kien, and especially with our Stock Doctor members. But before we get started, just a couple of announcements. All the information we share today, all of a general nature and shouldn't be construed as personal advice. And also all of the performance metrics and data, all historical. So shouldn't be relied upon as a guide for future performance. And also, we've got our end of financial year sale happening at the moment. So if you've got any family or friends who you think would like to take up a Stock Doctor subscription or where it's really appropriate, then get them to jump on our stockdoctor.com.au website, and all of the information's there and all of the pricing, discounts, etc. So simple as that. Also, Monday is a public holiday here in Melbourne, so where office is closed, and therefore there'll be no Lincoln Live on Monday morning. So let's get stuck into things now, Kien. May delivered another exceptional month for equities following the April dip, where markets were down globally. The All Ords rose for the month of May 4.1%, while the S&P 500 in the US surged some 6.2%. And a key driver of the US bounce was the fact that Donald Trump relieved tariffs, gave a 90-day pause to those, especially those that are impacting China and Europe. So the delay certainly eased tensions and lifted market sentiment.
Yeah, that's right, Tim. And furthermore, in the US, confidence was boosted by the strong earnings season, Tim. You know, talking about the fundamentals there and how the fund invests in some of those stocks, but especially in those major AI names, artificial intelligence, tech giants like Microsoft, Nvidia, and Meta. They all beat expectations, and that fueled the momentum as well. And here in Australia, we had easing inflation, and that also caused the RBA of Australia to cut the cash rate to 3.85% in May. And this supported rate-sensitive sectors like technology, telcos, REITs, and financials.
Yeah, great to see a couple of those names you mentioned in our Lincoln US Growth Fund, Kien, NVIDIA and Meta. NVIDIA is another new recent inclusion, but yeah, love to see those names. And on the back of all of that too, our Lincoln funds had a terrific May. So yeah, all of what you said certainly did boost sentiment. And while markets performed well, our star growth stocks did too. And they actually did even better, returning some 6.5% for the month of May, outperforming the All Ords by some 2.4%. Key contributors included good old Pro Medicus, just keeps on keeping on. Objective Corp had a nice little bounce. Wise Tech, and a lot of our gold holdings too, which also supported the Lincoln Australian Growth Fund. You know, we've got a heavyweight position to gold at the moment, just organically because of the fundamentals, just roll with the fundamentals. And because of that larger contribution to gold, both in the Star Growth Stock portfolio and our funds contributed strongly, and many of them jumped over 20%.
Yeah, incredible, Tim. And what about for the year to date?
Yeah, Star Growth Stock's up some 19%, well ahead of the market's 12.4%. So great results there for this financial year to date, Kien. So looking like we'll be closing the books at June 30 with significant results for our members, those that follow our Star stocks especially. And it's great to see that outperformance of the market, because we've got to be adding value, and we are. So that's very, very comforting. All of this highlights, Kian, the importance of staying focused on high quality businesses that are financially sound, and most importantly, especially in the current environment, blocking out the geopolitical noise.
Yeah, and let's not forget, Tim, the income investors as well with our star income stocks. They rose by about 2.8%. So it was quite modest, but over the course of the year, they've returned around 13%. So in line with the broader market. But with the income stocks, you've got the average yield of around 6.1%, providing that attractive appeal. And looking ahead, though, you've got lower interest rates too, Tim, and that could potentially support those high yield sectors like REITs, telcos, utilities, and consumer staples. We've seen that those sectors do quite well over the last couple of months.
Yeah, and obviously with the income stocks too, Kian, you get less volatility. They're more defensive in nature. So great to
Mm.
see that they're producing great results with excellent yields, and most of them paying those 100% franking credit, which our income investors love. So, Kian, now let's take a look at some key star stock highlights for the week. And first up is fashion retailer and star growth stock Lovisa. The company announced that John Cheston has officially taken over as global CEO and managing director from the 4th of June 2025, replacing Victor Herrero. At the same time, Mark McGuinness was named executive deputy chairman. The market responded strongly to these announcements, with shares jumping some 8.2% on the day, despite broader retail softness. So, yeah, well received by the market, Kian.
Yeah, I know, Tim. Management is so important here, and it's a major leadership shift. You've got Cheston and also McGuinness. They both bring strong retail experience and previously worked together at Premier Investments as well. And Cheston, he led the Smiggle brand and also had solid operational expertise there as well. While McGuinness, now also he's been the global CEO of BB Retail Capital, and that company is Lovisa's largest shareholder with about a 39% stake. So it's quite well known in the retail sector. And these appointments, they signal Lovisa's global growth ambitions as well. You've got Cheston, he'll be focusing on the operations, while McGuinness, he'll be supporting Chairman Brett Blundy and the board on that long-term strategy.
Yeah, really good, Kian. It's just, when we do a bit of a check on leadership and people, we've got to obviously dive a little deeper. And I'm not here to name and shame, and the past is the past.
Mm.
But obviously, when we do a Google search on a Mark McGuinness, obviously there was some issues there when he was a part of David Jones. So anyway, we just highlight that as a bit of an observation. We've got to look at the people, we've got to look at leadership, and we want really clean backgrounds. But at the end of the day, that they meet the numbers. But I just highlight that as something we should be aware of. I also noticed, Kian, that Cheston's pay is more modest than Herrero's, which is great. Real positive there. He's on 2.35 million a year, which is, obviously substantial, but it's sort of still in line with shareholders' interest, with especially if the stock price does well. And he is also receiving some performance-based bonuses as well. McGuinness is earning $2 million in cash, in a cash salary. What's your take on those levels of remuneration, Kian?
Yeah, in effect, Tim, with these type of things, you've got top tier talent, and they tend to command top tier pay, and both are highly regarded in the industry. You've got Cheston's package, which reflects a shift towards a more balanced executive remuneration, aligning with shareholder expectations after, remember, past pushback from Victor Herrera, who was paid. Now, if you compare that, Victor was paid close to around 30 million, Tim. So this is a
Wow.
substantial reduction to that.
Yeah.
That said, though, Tim, you talked about governance and the importance of that. And I think McGuinness, he kind of has learnt his lesson, after the David Jones saga there. But I believe here, some of the other issues I think are quite important is if they can provide better transparency, especially the issue here is McGuinness. He continues to report to Brett Blundy at BB Retail Capital. So there is a potential conflict of interest here. So clearer disclosures would give investors greater confidence here.
All right, so we'll keep a close eye on all of that anyway, won't we, Kian?
Mm.
Moving across from retail to resources now, Kian. A few of our members are wondering why energy giant Woodside Energy lies within our star growth stock universe, despite the weak outlook, with earnings growth and revisions looking very negative at the moment. And I know it's a stock that we discuss heavily in our weekly investment committee meetings.
Yeah, definitely, Tim. We had a quite intense discussion about 2 weeks ago on this, Tim, and
Boxing gloves are out, Kian.
yeah, no, definitely. Yeah. But in terms of resources, one thing to keep in mind is it's very difficult to manage, especially within that quantitative framework. And the
Yeah.
reason for that is, especially around this discrepancy, is because Woodside is investing for growth and is also in a transition phase. And then, aside from the weaker oil price, which has dampened earnings expectations, there's also this natural decline in legacy Australian assets that they have. Remember, they've sold a partial exposure of Scarborough LNG to a Japanese group. So there's less production, meaning less growth over the next year. So, but that's only a short-term issue. At the same time, also, you've got the company investing heavily, nearly 7 billion in financial year 25 alone on these large scale projects like Scarborough LNG. They've also got Beaumont ammonia, Louisiana LNG as well. And by financial year 27, the picture changes dramatically. Scarborough, that comes online. You've got Beaumont, which reaches commercial production. And you've also got these capex pressures easing as well. So that means in financial year 27, which we can't see on screen on Stockdot just yet, but earnings are expected to rise substantially. And that marks a turning point for the company with capital heavy transformation to production led earnings growth. And that's going to start to eventually be realized.
It's a fair way down the track, though, isn't it? So we just need to be really mindful of that. And equity prices could do a number of things in between now and then because of those negative earnings revisions. And we've got to, based on their June 30s, we'll be looking at those closely to see if they continue to meet our criteria. So it's really important to keep an eye on all of those forecast numbers, especially their ROAC or return on invested capital figure. So thanks for the clarification there, Kien. Really, really interesting. It is about the future for Woodside. But given the weaker outlook numbers, is there a strong possibility that Woodside could be removed as a star growth stock in the not too distant future?
Yeah, Tim, that's definitely the case. Okay. And but with that said, though, as we touched earlier, Tim, quantitative metrics often don't align well with resource stocks, which are heavily influenced by volatile commodity prices as well. So Woodside is still considered a high quality energy business. It's got a solid pipeline of growth projects. Yeah, and adding Woodside can provide that diversification benefit to a portfolio, but investors need to be comfortable with the risks that come with this exposure, and that's being exposed to unpredictable energy prices over the next couple of years.
And now to under the microscope, Kian. And this week we have a look at a company that caused any of our members a bit of pain if they were still in their portfolio because they had a significant price drop. And that's IDP Education, ticker code IEL. For those that are less familiar with the company, IDP Education is a global leader in international student placement and co-owner of the IELTS English Language Test Program. It operates across more than 30 countries, helping students navigate visa, course, and university options with a particular focus on Australia, Canada, and the UK. So they're really a recruiter for universities, if you like. The company has been a star growth stock for much of the past decade, currently a borderline star growth stock, but with that reputation is now right under pressure because of announcements during the week. Now, a lot of the reasons for the downgrades were clearly articulated in the active risks in Stock Doctor, both in the strategic comment and the active risk section. So they were quite significant for a star stock. So they were very visible. However, we hung in there with the business believing that based on Golden Rule 3 forecasts, that the company could turn around. But unfortunately, there are deep concerns there. So Kien, explain to us exactly what those announcements were and the reason for the earnings downgrade during the week.
Yeah, sure, Tim. The downgrade was driven by a significant drop in those IELTS English language testing volumes, especially in Canada and Australia, after policy changes reduced student visa approvals. And that impacted both testing revenue and broader placement services as well. At the same time, though, IDP is continuing to invest in digital infrastructure and marketing to support its long-term strategy, which adds further pressure to their near-term margins.
Mm. And the market certainly didn't hold back, did it?
Mm.
Wow, clobbered on Wednesday, down, close to 50%. And it continued over a couple of days. Why was the reaction so extreme, Ken? Because it did seem incredibly heavy, especially given that the risks have already been out in the open, really.
Yeah, a lot of it appeared to be out in the open. But the problem is, it wasn't just a downgrade, Tim. It was a reset of expectations to higher uncertainty. So when you look at this, though, management admitted they had limited visibility on the enrollments. In addition, IDP appears to have weaker than expected pricing power as well, meaning they are struggling to raise placement fees to
Right.
offset those falling volumes. And on top of this, the business could be losing market share to those low-cost digital platforms like Applyboard. So when the growth narrative breaks without a clear turnaround plan, the market tends to reprice sharply, and that's what we saw.
Yeah, you can't pick them all, and sometimes these stocks do surprise, don't they? With the excellent extra research that you actually conducted on Thursday. So well done for that. But it really did give us insight into what you've just articulated. But after such a significant drop, Kien, are we starting to see signs of value emerging in the business, or am I going a little bit early there?
Yeah, good question, Tim. And I suggest it's not quite there yet. And that's because we don't have that clear visibility on when earnings might recover. It's very difficult to confidently call a bottom at this stage. While it's a high quality business with a strong global brand, they've got solid cash flow and a reasonably healthy balance sheet, the return on equity is expected to decline to around 12%. And we are still waiting for consensus numbers to flow through on Stock Doctor, though.
Yeah, so we're here. Where to from here, Kien? Oh, sometimes you just got to rip the band-aid off, don't you?
Yeah, that's right, Tim. In light of the significant downgrade, you've got limited earnings visibility now and the weakening of those key financial metrics, Tim. We've made the decision to cease coverage of IDP as a borderline star growth stock. There's now been a clear hit to management credibility as well, Tim. The downgrade came with little warning, and the
Mm.
choice to maintain investment levels despite the declining earnings hasn't been really well received.
Yeah. All right. Thank you, Kien. Really insightful. Management will need to work hard to rebuild trust with both investors and the broader market going forward. They'll have to work super hard. Meanwhile, the short interest on the stock remains elevated too. I can't emphasize enough the importance, as I mentioned before, of really understanding the active risks for all of our star stocks. Some there's not much at all. But for others, like IDP, when you read the commentary, when you read the active risk section or the strategic comment, you'll get a sense for the level of risk that exists. So really absorb yourself in that. So when you're making investment decisions or you're managing your portfolio, you can really get a good feel for those stocks that may carry more risk than others. And for those ones, if there is a negative downgrade like we've had with IDP, share price will be affected heavily. So just keep your eyes on that and make sure you really do digest the commentary that Kien and his team provide. And now to question of the week, Kien. And with the end of financial year fast approaching, a timely question from many of our members is how can Stock Doctor assist me in preparing for tax time?
Yeah, Tim, and the first step here is to ensure that your portfolio in Stock Doctor accurately mirrors what's in your broking account. So you can do this by selecting your portfolio within the portfolio director and reviewing the holdings and transactions as well. But don't forget to double check your dividend payments under the recent income section. It's a key part of the whole picture.
It sure is, Kien. And once your portfolio is up to date, head to the reports tab. There you'll find a breakdown of your income and capital gains or losses. Each income entry is conveniently linked to the relevant tax return label, which makes completing your tax return so much easier. In the capital gains section, you'll see a detailed summary of any gains or losses from the financial year, including the option to carry forward any capital losses from previous years.
And if you've realized significant capital gains this year, as likely given markets have powered along, one tax efficient strategy is to consider tax loss selling. And this involves identifying and selling those underperforming stocks, especially those that are financially weak, for instance, to offset your gains with those losses. But just be mindful here of the ATO's, what they call wash sale rules. These prohibit you from buying back the same or substantially similar stock within a short time frame, typically within a few weeks.
Yeah, excellent guidance there, Kien. And a smarter move may be to reinvest in a different company within the same industry, ideally one with stronger fundamentals, one of our star stocks that meet your particular criteria. And that's where Stock Doctor makes things easier by helping you identify financially healthy alternatives.
Yeah, that's right, Tim. And finally, when you're ready to provide reports to your accountant, simply head to the Reports tab, select the appropriate date range, usually covering the past financial year, for instance, and export the report as a PDF or CSV and send it off to your accountant, making their life easier and potentially allowing them to charge you less fees as well. So for other asset classes, just like cash, bonds, or property, check under the cash and term deposits and other assets section as well. This ensures your entire investment portfolio is accounted for accurately as well.
Excellent, Kien. Well, that's all we've got time for today. Always love sitting down with you and sharing our passion with our members. Thanks very much.
Likewise, Tim. And also next week as well, on Tuesday, we have our stock room webinar, Tim. And that includes you and the analyst team there to break down the bank reporting season that we've just gone through, and also talk specifically on stock updates and answer any of your questions on stock. So make sure you tune into that.
Yeah, can't wait for that one either, Kien. Really look forward to it. And just a reminder too of our end of financial year sale. Any family and friends who you think could benefit from Stock Doctor at discounted prices, get them to jump onto our website, www.stockdoctor.com.au, and all of the details are there. So yeah, just everyone, there's plenty of noise out there. Keep blocking it out. The market is so resilient, so unpredictable, but so resilient. And I think that sheer weight of money that's coming in from passives keeps propping it up. But it's also, I'm very, very proud that we continue to outperform the market. So therefore adding that value above other alternatives. So, yep, that's all for today. Take care and have a happy, healthy and prosperous week.